In just 2 days, I was able to turn $29,000 into $90,000 by trading options. Or to put that another way, for a couple days worth of work, I was able to secure a 210% return of $61,000, which is honestly pretty mind-numbing because that's more than I used to make in an entire year. In this video, I'll be breaking the entire trade down, what I saw, what I didn't see, and the management of the entire situation. But you need to know this. What happened for this particular trade is a classic. You're going to see this setup time and time again, and I promise you this, if you master everything we talk about in this exact video, man, oh man, is it going to really help out your trading career. With all that being said, I know this is a new style of a video for me, so if you enjoy these type of trade breakdowns, a little bit more of educational work, let me know in a comment below. Of course, don't forget to like and subscribe and all that good jazz, but now let's rock. My goal is to make this as easy to understand as possible. So because of that, there's three major pillars we're going to be focusing on: price structure, price momentum, and options flow. But before we get into those, I kind of need to set the scene of the situation. So obviously some time has passed, but I'm intentionally covering up the chart because you never know in real time what the next bar is going to be. So this trade all took place on Friday, March the 21st. That's why I'm just kind of stopping the chart here on Thursday the 20th. There's a couple things you need to know. First of all, price structure, pretty bearish. We have lower highs, we have lower lows, we have a recent little bounce, but this could easily just be a lower high. We kind of had this breakdown, but overall, we're just kind of seeing these 3 wicks. Clearly, the market didn't really want to push up. I should also note that the bar I'm intentionally hiding, that is Friday, March the 21st, which isn't just a normal Friday. It is the monthly expiration, but it was also the quarterly expiration, making it a quadruple witching day. Remember, those days are not bullish or bearish, but we know there's 4 major types of contracts that are going to be expiring. So there's going to be a lot of volatility because people holding those contracts have to make decisions. Do they want to roll it? Do they want to be bullish? Do they want to be bearish? So this was the setup going into it. We had bearish price structure. Clearly, this is just an EMA right here. It's bearish, so the price momentum is bearish. And we knew we were coming into a volatile event. And I should also note that looking at the options market, the entire chain was put dominated, as in there was a lot more put open interest than there was call open interest. So going into this day, not only was my bias bearish, but actually was carrying puts into the day, putting these things together. Bearish price structure, bearish price momentum, and I also knew that the option chain was put dominated. So I figured, okay, my mindset was this. Yes, I have this bias, but regardless, I just think it's going to be a big moving day. So if I could get onto the right side of the trend, I can make a lot of money. And I already had a bearish position because I thought that was going to be the right side. So that could easily sound super bearish across the board. Price structure, momentum, and the option chain all favoring the bears. Yeah, it looks like we're going to break down. But there's a caveat I need to add in here. Number one, volatility was starting to fail. Remember that volatility tracked by VIX commonly moves inversely to the overall S&P 500. So if you see this going up, probably the market's going down. If you see this dropping, the market's most likely going up. So they have an inverse, as in an opposite relationship. I came into this day, Friday, March the 21st, bearish, but I should note volatility was falling. So that's one thing going against me. The other thing I should note is going into quadruple witching, even though the overall option chain was put dominated, it was getting less and less put dominated, as in some puts were dropping, some calls were picking up, but overall the puts were still winning. They just weren't winning to the same degree as we were trading throughout the week heading into Friday. So putting that all together, I would say that the situation was bearish, but there was a couple things that were in the back of my mind that kind of told me you really need to be paying attention. And that brings us to market open on Friday. We opened up and we started to puke, and I felt like a genius. I said, okay, we're just going to keep going. And in reality, on the daily chart right here, I actually thought we're going to take out the low on Tuesday. And I thought, okay, realistically, we could puke down to the recent local low, the low from Thursday, March the 13th. That was my overall goal, around 5,500. I thought that's exactly what was going to happen when I saw this weakness. Then we made another fresh low, and I kept noticing that we kept getting rejected at 5,625. That is by no means a surprise. It was a large open interest level of the day, as in there was a lot of active traders targeting that particular strike. And I thought, okay, resistance. And then around midday, it shot up. That was my first warning shot that maybe I am not right to have a bearish position. And then it quickly got smashed. This had something to do with Trump, and then there was some sort of tariff discussion, but regardless, it popped up, came down. It was a 30-minute ordeal. And then once again, I saw the rejection at the 5625. And I thought, okay, that open interest is once again acting as resistance. And as long as the price structure goes back to being bearish, because right here at this point in the day, we had some higher highs, but we had some lower lows. It was indecisive. If you have higher highs and lower lows, that is a broadening formation, as in the market's not really trending, and it's actually my least favorite setup. And we started to come back down, and I thought to myself, as long as we get back around 5,600, once again, a key technical level, key psychological level, but as long as we could take out those lows, that's all right. That's good. The bears still have some control. As you could tell on the chart, everything changed right past noon. This is where things got a little bit funky, and it's where I had to admit that my initial read on this quadruple witching day was 100% wrong. So from a price structure standpoint, you can see we put in a higher low, and now we have higher highs. When you have higher highs and higher lows, it's really hard to be bearish. So that's one piece of information. The second piece of information is not long after that, look at this momentum. Once again, this is just EMAs. We shot up above the EMAs. So that means that momentum is going from bearish to bullish. And really the dagger in my heart for my initial read on the situation was the options flow. Now, to be fair, we can't see the rest of it. Let's just pretend we were looking right past noon. This is pretty much it here. Yes, options were pumping, as in bullish. Then we came down, could not make a fresh low, and then options started to pump again. If you're not familiar with this service is, it's called Spot Gamma. Not only does it show you the price of the underlying, in this case, the S&P 500, but of course you could use it for your favorite index, your favorite equity, but then you get to see the options flow for the 0DT and then all expirations put together. And my point here is that we saw options really start to pick up. So coming into this situation, once again, I want to keep this simple. We had bearish price structure, bearish price momentum, and the options chain was dominated by puts. I was looking for that trend to continue, but clearly sometime between 12 and 12:30, that was wrong. It was evidently wrong because all of a sudden price structure is starting to look more bullish by the higher highs and the higher lows. We're seeing momentum switch, and we're seeing options favor the bulls. All of a sudden, my bias of saying, yes, I am bearish is starting to get blown to bits. And this really brings me to my first key point of the video. Every successful trader I know is a good loser. When they realize that things are going awry, they admit that they are wrong, they are good at taking losses, and they just throw in the towel. They don't let a position get out of hand by any means. Really good traders, if anything, are good risk managers, and they let the winners take care of themselves. So right here, even though I had this bias, even though I came into the day with puts, you have to read the data as it is at that moment in time. And I said, oh wow, we went from bearish, but now the three things I care about, structure, momentum, and flow, are all telling me the bulls are in control. So you just have to admit you're wrong. So that's exactly what I did. I cut my initial bearish position, and yeah, it was painful because that's my bias and no one wants a lock and a loss, but I was being realistic about the situation. And when I realized that we're just not bearish, it's not like we went to neutral, we are now legitimately bullish. So as you can see, I bought these S&P 500 calls right around 1210, which is right when things started to look legitimately bullish. Now, a really quick note, of course, you never know what the next bar is going to be. It could be a fake out, it could be a continuation. You never know whether bullish or bearish. But what I do know is the major things I care about were all looking bullish. And on top of that, I was able to get into the trade with minimal risk. And when I say minimal risk, my risk was literally just this recent low. If we take out these lows, I'll get out because then we're back to that bearish initial trend. But right here, my risk was not bad at all. I was getting in with minimal risk, agreeing with the new trend. And then at that point, I'm just going fishing, seeing if I could catch something. And man, oh man, did I catch a trophy fish. Not only did price pop, came down a little bit, really strong recovery, but at this point, the entire time I was watching the option chain. The intraday price structure had higher highs and higher lows. The momentum was on top side of the EMA favoring the bulls, and the options market, not only the 0DT, but further down the chain, was all starting to get much more bullish. It was telling me that the bulls were in the driver's seat. So at that point, I thought, should I be swinging these or not? Should I be locking this in? And then that's when I came back to the daily chart where I realized we had all these wicks, and granted, we didn't have that official breakout on Friday, but there is a very realistic chance that from this low, this next Tuesday low, at this point on this particular time frame, this could be a higher low with some higher highs, as in this could be the official bottoming. And I thought it is worth that risk, especially because when I saw it changing deep into the option chain, and then obviously that led us to over the weekend, basically Friday to Monday, where we got this gap up and this push, and I just basically rode that all day. And then when the market was slated to close at 4 p.m., I figured it was better to lock in all the money because the expiration date was obviously the upcoming Friday, so Theta was going to start to eat me alive. I was already up more than I used to make in an entire year, and at that point, when I was running the math of it, I saw that the seasonality of Tuesday was slightly bearish and the next really bullish day was Wednesday. So did I want to hold it again? And the answer was no, because if I still like the setup, guess what? I could always just pick a further out expiration date. So by the time I ran all the math and the models and just trying to not be greedy, I realized the get in is good now, so you might as well take it. So that's exactly what I did. Right before the market closed, I gave the market a chance to try to push, but right before it officially went dingity ding 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 on the day, I hit the sell button, locked in the money, and rode off into the sunset. So now you're probably thinking to yourself,
that doesn't seem complicated at all.
It's not. That's the secret to good trading, is simplicity is king. You look at price structure. Are you getting higher highs and higher lows, or lower highs and lower lows? Pay attention to the extremes, those highs and the lows. What's going on with momentum? Is your EMA or your SMA, whatever your favorite moving averages are they going up? Are they going down? Or are they going sideways? And then obviously right now, because of the massive popularity in options trading and obviously the implications on the market makers hedging, you have to know what is going on with flow. Are people buying calls or selling calls? Are people buying puts or selling puts? Who is dominant? Is it a call dominated situation or a put dominated situation? Putting all that together will give you a very good read on the situation, but you have to also be in control of your own discipline. Coming into quadruple witching, I knew that there was gonna be big moves coming. Obviously, I didn't know if it was bullish or bearish, but my bias was bearish because I saw on the daily that the price structure was coming down, momentum appeared to be weak, and I knew that the option chain was put dominated with two major caveats. The volatility started to come down, which is actually a little bit more bullish, and even though the option chain was put dominated, it was less put dominated throughout the week. It was weakening every single day, a little bit by a little bit. But around noon, when we got some Trump tariff related discussion, I had to admit that I was wrong. In the 10-minute time frame, we had higher highs, we had higher lows, options were turning, momentum was turning, and I knew it was quadruple witching, as in if you can catch the proper trend, you can make some seriously good money. So not only did I get out of puts, I punted it extremely hard in the call direction because everything aligned for that trade. So not only do you want to be realistic of which way the market is truly going, whether it favors your position or it doesn't, it's in that latter case, when you're wrong, that you have to be able to admit it to yourself. Not only are you risking money by not admitting the actual situation to yourself, but you're also risking missing out on the opportunity of a very good trade. That's exactly how in less than 2 days, I was able to turn $29,000 into $90,000, a net gain of 210%, also known as $61,000, also known as more than I used to make in an entire year. My goal in making this video is sharing my simplistic approach to the market in hopes that it helps at least one of you guys improve your trading to the next level. Of course, if you have any questions, comments, or concerns, let me know in a comment below. I'll do my best to get back to all of you. And I also just want to plug this that Monday to Friday on the other channel, we actually end up doing a live show from 9 to 11 where we do live trading, and I'm more than happy to show you what I'm doing in real time and also answer in real time any of the questions on your mind. That's what I have for you. I hope you enjoy the video. I appreciate your time. I appreciate the good vibes. I'll catch you in the next one. Peace.